Hello everyone, thank you for taking the time to watch our video today. My name is Philip Clark. I am the Regional Sales Director for International Property Alerts, and today I have the honor of speaking to Marian. Would you please introduce yourself?
Absolutely. No, thanks, Phil. My name is Marian Dzhenkov from Lifetime Capital, and I look after the APAC region. I'm a mortgage and protection advisor, and now have been doing it for almost 9 years. And I myself am based out here in Asia, in Bangkok currently.
Amazing. Okay. What today's discussion about is, of course, Marian, I want you to tell me a little bit why UK property owners are currently looking to invest outside of the UK, such as Asia, specifically like places like Bali, Phuket, even Pattaya in Thailand. Could you touch on that a little bit?
Absolutely. Yeah. I mean, we are seeing a lot more interest in those regions nowadays for sure. And, there's multiple reasons. I guess for those who have been in this part of the world, you realize how amazing it is. And, there's the lifestyle concept that you don't really get in the UK. I mean, as you can, myself and you are based in Asia as well. We know what it's like here. We've been, we are from the UK. As much as we love the UK, it's, it has become a lot more expensive to buy property there. The lifestyle element is completely different. And of course, many people nowadays, they kind of open up to the idea of exploring new markets. Mm-hmm. So, I would say real estate has been, really strong in the UK, hence why people have made a lot of money from it. And, there's been people that have purchased properties, 20, 25 years ago would have probably doubled their equity by now. And, we all know how strong the UK market is, and many foreign buyers have been buying in the UK market. However, in the latest years, with mortgage rates kind of going up and taxes and everything, a lot of UK landlords and people based in the UK are looking to invest elsewhere. So, as we touched upon it earlier, lifestyle is amazing, but also price points, right? We know what London is. London's an amazing place. Don't get me wrong, but
cost of living.
Yeah, cost of living. Yeah. And purchasing a property, first-time buyers, is very difficult for them to purchase a property in London. We're looking at $500,000 plus. Whereas you look at places like you're in Manila and Bangkok, Phuket as well, and Bali are very, very popular for tourists. We're looking at much cheaper prices, very strong demand as well in terms of rental. So you're getting high rental yields if you're a kind of an investor. You can also use your property as a holiday home, and foreigners can own properties there. There's that myth, I would say, and a lot of people have asked me that. It's like, oh, you can own a property in Phuket or Thailand or Indonesia. You can, as a foreigner, you can own that.
Yeah, foreign quota. Yeah,
there's a foreign quota. There's a foreign quota, and the barriers to entry are very low, and taxation is very low. Obviously, probably the biggest reason why people don't want to buy in the UK at the moment, or should I say, are looking to get some money out of the UK, is because taxes have become, pretty high. Owning a property or purchasing a property, and income as well. So.
You're absolutely right. Yeah, you're absolutely right, actually, Marian, because I spoke to a client the other day and she was saying to me, she owns a property in Scotland. She also has one in Manchester, in the city centre. And she was saying to me, she's not going to start making money for the first 5 years because of a stamp duty.
That's right.
And that's why she's looking to, pull some equity out and put it into the likes of Asia, because you get an immediate turnaround. Which is obviously good. But you know what? I actually have a question on that. What would you say to a client? Why would you release equity from a fully paid house instead of using his own liquidity? What are the positives?
If you have a property in that you've bought, I don't know, 20 years ago, or even 15 years ago, and you've got it at, when the rates were quite cheap. We all remember that in 2007-8, the base rate in the UK went down to the likes of 0.1 even. So borrowing was very cheap. People borrowed money, but that also means they paid it off quicker, right? Yeah. Or if you bought it before that, early 2000s, even better. You've definitely doubled your equity. You've got a lot of cash sitting there. You're likely to have repaid the whole mortgage, if not most of it. So why not borrow that money from the property? Say you have, I don't know, less than 50, even if you have less than 50% left on your mortgage, the maximum that you can take out of your current property is 75% loan to value. So 75% of the value of your property It's
Wow.
basically cash sitting there that you could take out. And I know what people are going to say. The rates are really high, and why would I do that? Truth is, the rates they did become pretty high, let's say 2-3 years ago. I remember, doing mortgages at the likes of 6-7% on a 2-year fixed, which sounds high historically. Sounds high for the last 10-15 years. Historically, maybe not so much. Sure, people remember rates being 10-11% on mortgages, but nowadays the rates are around your 4%. So the Bank of England base rate dropped, so you're borrowing money essentially at a rate of 4%, which, let's be honest, if you compare that to any sort of other loan, whether secured or unsecured, is pretty good. And if you could, you have a property in London or even Manchester. You mentioned Manchester earlier. Manchester's become pretty, property prices have significantly gone up in that area. So you're easily sitting on a £500,000 property, let's say. All you need to take out is £200,000, which is what, 40%? If you look at it that way, borrow it at around 4 to 5% interest rate, and you can purchase an apartment or a condo or a villa in the likes of Bali or Phuket. And of course, those areas are fairly new when I say new markets, they are now fairly well established, so you can see a track record of good rental yields, and we're talking rental yields that are much higher than what you ever get in the UK. We're talking, very easily can get yourself a 10% rental yield in those places, whereas in London and Manchester, you're looking at 4 to 5% gross yields. So we're almost looking at those. So long story short, you can borrow money from the UK at around 4% and purchase yourself an asset, which is much, much cheaper than what you could ever purchase in the UK, which will potentially get you up to 10, sometimes even 15%, depending on what kind of rental you put it on, whether it's a short term or long term. But that's more kind of your area of expertise on the properties themselves, right?
Yeah, absolutely. And touching on that, the occupancy rate as well is going to be far higher. If you buy in London, of course, it depends what type of property it is. Don't get me wrong, if you've got a flat, an apartment in the central of London and people are coming on business, and yes, the occupancy rate is going to be relatively high. However, you in Bangkok, you know what it's like. You've got people coming for business trips, you've got people coming for holiday because Pattaya is only an hour away, where you've got the lovely beach side, and of course in Bali, you and I both know it's just a holiday destination for everybody around the world. I was speaking to someone the other day, they've had I think it's 7 million tourists last year. So demand is not an issue, and the infrastructure, they're keeping up with it as well. I've seen occupancy rates pretty high with property in Bali, but like you said, touching on it again, yes, it is my place of expertise. And for example, a 1-bedroom villa in central London, 2.5 kilometers from the beach, doesn't really exist.
No.
But you can get that in Bali. You can get something like that for around £100,000. So
absolutely.
Yeah, exactly. So if you're speaking to an investor in the UK or a property owner in the UK, how would you explain to them to finance purchasing in Bali or Thailand?
I mean, it really depends on the client situation and what kind of cash they're sitting on, what kind of equity and where the property is, because I'm not suggesting, and by all means I'm not saying people should be gearing up and borrowing the maximum from their UK property that they've worked hard for and been paying for 20-25 years. I'm not saying you should do that. Obviously, really, we need to look at it in a sensible manner and look at what's best. But what I would say is, we can review it for free as well. We can review the portfolio. We can have a look at what we can take out, what rates there might be, because I think many people don't realize you can do that. And many people would have spoken to their bank and they would have picked up the phone to Barclays or Nationwide, whoever their lender is, and said, I want to borrow more money so I can purchase elsewhere. And they would be like, no, that's not for us. You can't do that. I've worked with more than 150 mortgage lenders in the UK. Most people don't even think there's that many banks in the world. So the mortgage market in the UK is very, very old school, but also regulated, which gives you an array of products, which is suitable for everyone, depending on obviously your situation. But some might be more expensive, some might be cheaper on the fees, whatever it may be. There's just hundreds of products out there, if not thousands. So what I would suggest is have a look at what you're achieving in the UK. Of course, speaking to your tax advisor, your wealth advisor is best, because you want to see what kind of tax implications you might have. If you're still living in the UK or you want to move out to this country that you're purchasing, or you might want to move out somewhere, that's very different. But I think borrowing money on a UK property, as long as that property is self-financing, meaning it can wash its own face, meaning that the rental income that you're getting from that property is enough to cover your mortgage costs, then you have nothing to worry about, really. And then obviously borrow that money. Your property is going to be rented out in London. Let's say you're getting £2,000 on your from the tenant. Take away costs and fees in managing the property. If your mortgage per month is less than £1,500, then you're absolutely fine. It's washing its own face, and you've released 100 to 200,000 or whatever you need to purchase elsewhere. And that new asset is going to be generating you income, because it will be, bear in mind, this will be an unencumbered property. So it's not going to be mortgaged, the actual property that you buy. So you only have one mortgage on your current UK. And of course, if you're from the UK and you already have a property in the UK, it's much easier process to borrow on that property rather than use your cash and borrow on new one overseas. Because let's face it, when you're a foreigner buying in countries like Thailand or Philippines, anywhere really, and you're a foreigner, it's very, very difficult, almost impossible to get a mortgage there. And let's be honest, the rates are not amazing. We know Thai mortgages, we know what it is like in Indonesia. Their mortgage terms and rates are not very good. And there's only a handful of banks that do mortgages, so you're best off going through the safe option in the UK.
Yeah, and this is also relevant, touching on that, to people who are interested in selling their property. It's a lot of discussions I have with many people over many years. Instead of selling your property, have you ever thought about what you're saying? Because selling a property, I get where they're coming from. They want to sell, they want to buy something bigger, but as you've just explained, pulling out equity, you own one property. Yes, you'll pay the mortgage, but that's effectively being covered by the property you're renting out in Thailand or Bali, which is luxury location, hot all year round. And that's covering your mortgage plus a little bit of income for you. And at the same time, you can take your family and stay in a villa and have a holiday home at the same time. So you're not just having one property, you've got two, you've got income, mortgages being covered, and then it's eliminated the sale, but you're climbing the ladder within the property sector. Right?
Two is always better than one, right?
Absolutely.
That's just how I see it. And of course, but having two assets is always better. And bear in mind, these are two assets that are still real estate, still property, still tangible. Two completely different markets. So you're kind of hedging against any sort of issues that may come in whatever that may happen in the world. And you rightly said, you're actually your mortgage is going to be covered by the property that you have in the UK, or that you're going to be receiving in the likes in Asia, whatever you end up buying will be pure income. And bear in mind that the income tax in those countries are much, much cheaper than they would be in the UK, right? So, there's so many kind of positives that you can get out, but selling, I actually looked at it myself for my property in the UK, because now I've been in Asia 4 or 5 years, and you're kind of thinking, right, should I keep it? But let's be honest, selling will not always get you the value that you think your property is worth. And at the moment, I think that's what's happening. People that have bought a property in the last 10 years, since maybe Brexit, and then obviously we had COVID, which obviously affected the prices. And I'm generalizing for the UK, different segments would have performed better than others. But take London, for an example. If you bought a new build property in London within the last 10 years, it's very unlikely that your property would have appreciated massively. And you're likely to be potentially selling it at a small loss. Or maybe in your head, the property is worth X amount, but then when you put it on the market, you see that maybe the demand, and you're not getting the offers that you want, because everyone's looking for a good deal nowadays. Everyone wants to, get a discount. So selling might not be the best option right now, because you might not get the value you want for your property. And furthermore, it could be quite a painful / long process to do that, because how long and kind of it can be very, very onerous process to buy or sell a property. We've got mortgage brokers involved, we've got banks involved, we've got solicitors involved, we've got the buyer's solicitor, we've got potential sale from their side, you need to potential mortgage from their side. So the process could take 6, 7, 8 months, and then till the very end, the client, your buyer might come out and say, actually, I don't want it anymore, because you've not exchanged contracts. In the UK, you exchange contracts right at the end, right, of the process. So anyone could pull out at that time. So from a time perspective, you might miss out on a great opportunity to purchase a property in Bali because you don't have access to the cash. Yeah, we say property is liquid. Yeah, we have demand in the UK, but truth is, in order to sell and actually have the cash in your bank account, the process could be pretty long, right? And that could mean you're missing out on an investment opportunity elsewhere. Whereas with remortgaging, it's going to be a much quicker process. The property's already there, or that. And actually, I'm just going to throw that in. If you have a property that's rented out in the UK, and it's, let's say, small mortgage or low mortgage, all that the bank needs to see is that the rental income can cover your costs of the property, so in order for them to kind of say, okay, that's a good enough asset for us. So realistically, they're not going to dig too much into your income. Some lenders might not. But what I'm trying to say is that the underwriting process is not too long. It's not too bad from a lender's perspective. So as long as they see that the property is there, you've got good enough rental income that can come from it, or is already coming from it, then they're happy to kind of lend you X amount. Basically refinancing and releasing equity is just going to be much quicker, much easier to do rather than selling.
Sounds like a no-brainer. Could you? I heard you mention tax earlier. Could you touch on that a little bit? So if an individual is due to pull equity out of a property in UK, let's say they release 200k, like you said, and then they purchase a property in Bali or Thailand, how would it work in tax implications?
I mean, obviously, when you're selling, if you were to refinance, there's no tax there because you're borrowing money. There's no transaction of the property. You're not selling. You're not moving ownership or anything. It's still your property. You're just taking cash out. You're just borrowing, basically. Once you move the money out, of course, there will be some sort of tax implications of purchasing a property overseas, whatever they may be. You guys, it again depends on where you're buying. But as we all know, in the likes of Indonesia, Thailand, they're not that high. So the costs of your purchase are pretty low in comparison to the UK. We know in the UK have like the likes of stamp duty, you have capital gains tax, you have income tax and all these things, which can be pretty high. So if you were to sell the property in the UK, we've all heard of capital gains tax, right? So you will be liable for capital gains should your property have gone up X amount, or there's a threshold which you don't have to pay, but anything above that, which very likely if you've owned the property for over 20 years, you will go above the threshold. You have to pay capital gains tax. But yeah, to be honest, tax is probably the most touchy subject when it comes to it, and it's the most complicated subject. So I always say speak to a tax advisor if you're looking at making big moves in your life, moving money out. But I'm pretty sure I can say this. If you were to refinance the property and buy elsewhere, your taxes will be lower than basically selling fully and going through the pain of that. And you can't escape tax. If you're paying tax, that means you're making money. So we can't really be complaining too much about that. If you're making money, yeah, of course there's going to be tax. But
and getting a second property.
And that being said, look, and getting a second property, of course, if you mentioned earlier about your client, if you were to buy, you've got the cash and you borrow from your current property in the UK and you want to buy another one in the UK, that makes you buying an additional property, which means you're going to be paying the additional property stamp duty, which is a couple of % higher than what it would be. So you end up paying almost double what a first time buyer would be paying, and owning one property. And then bear in mind that you're going to have to be paying whatever charges on that property you need to pay, service charges that we're talking about, council taxes we're talking about.
Different countries, different rates. Different countries, different rates.
And income tax, right? Yeah. One market we didn't mention was the UAE, right? So we're seeing a lot of people from the UK, moving to the UAE mainly for tax purposes, right? Yeah. And that's where they've really kind of benefited from that in terms of the property prices. They've gone crazy because people are buying property there, and property in Dubai, and Dubai is a mega city, right? Properties in Dubai are still cheaper than they are in London, and arguably lifestyle is, depending on what you like, but lifestyle is still very, very good. It's a very safe place. Yeah?
Definitely warmer.
Yeah, definitely warmer, that's for sure. Yeah, especially in January. But no, what I'd say is people are still buying. People are buying in the likes of the UAE and elsewhere, mainly for tax purposes, mainly because they want to move their tax residency, or they want to have an asset in a place where taxes are lower. So that's part of the reason. They have other risks involved, but we're talking about pretty safe options. We're talking about markets that people and foreigners have already invested in for the past 10-15 years, and there's a track record of people successfully purchasing and successfully actually making money and paying lower tax. So
absolutely, we have a development in Phuket, Thailand, which is it's limited to the amount of building they can do, and it looks like it's going to run out rapidly. But the reason I'm touching on it is because there's this particular development, 65% sold out, and 60% of the buyers are actually from the UK. The reason being is because the developers are UK based, so most of the data, most of the interest parties are coming from the UK. But it just goes to show why. It's generating some fantastic income. The taxes are lower. The climate is better. You can picture yourself next to a beach, and January, February, March. If you've got a sustainable business there in the UK and you've got a house generating income, you've got a little spare cash, hop over to Phuket for 3 months while generating income. It's just a win-win situation. So the key takeaway here, Marian, I'm sure you would agree, is use your UK equity wisely, structure investments correctly, and focus on stable rental income abroad, right?
Yeah, absolutely. And in fact, great that you mentioned Phuket. I'm flying there tomorrow myself and seeing a few properties there. And if you haven't been, I'd say to people, check it out, because once you come to those kind of areas, you see why people love it. You see why, not just from a lifestyle perspective, but from an investment perspective, it could be, you can make your money go further. And truth is, you've got many options, especially if you already have a property in the UK. It basically means you've got cash sitting there that is ready to be used. So yeah, obviously everything has to be done wisely. So speak to your specialists and explore your options.
Amazing. Well, Marian, listen, I want to thank you so much for sharing your insights for UK property owners. By the way, any UK property owners watching this video, leveraging existing equity to invest in Asia can be a smart way to grow income, and it adds diversity to the portfolio, tangible portfolio. Now, to our viewers, don't forget to subscribe to this video. If you want to know information, we're going to have a barcode where you can select, or alternatively, you can call me on the number below and the email provided after this video. You will speak to myself and Marian, myself in regards to property, Marian in regards to pulling out equity. He'll teach you and show you exactly how to do it. But anything else you want to touch on before we end this video?
No, absolutely. No, thank you for having me. I hope it's all very clear, and whoever's watching this video, everyone's got different situations, so I'm more than happy to kind of jump on a call, Zoom call, or meeting if you're out in Asia, to go through the details and tell you what's best for your situation.
Sounds good. Marian, thank you so much. Much appreciated. Like I said, once again, you want more information, follow the details after this video. See you all soon. Thank you.
Cheers, Phil. Thank you.